confirms displacement. The gap indicates that the market has moved quickly, leaving an area of inefficiency caused by smart money. This type of move shows that institutions are pushing the market higher with force. A bearish displacement move is a strong downward price movement, indicating that smart money is selling heavily. To recognize a bearish displacement move, look for at least 3 bearish candlesticks in a row. These candlesticks should have large bodies and little to no wicks. The price should drop with strong momentum and limited retracements. A fair value gap, or FVG, between the candlesticks confirms the displacement. This gap shows that the market has dropped quickly due to large institutional selling. This type of move shows that institutions are driving the market down. Now let's dive into some real chart examples to help you understand how to identify bullish and bearish displacement in action. First, we'll look at a bullish displacement example, which occurs after a sell-side liquidity sweep. In this chart, the market was trending downward and approached a significant support level. Many traders expected the market to break through this support and continue lower. As a result, they placed short orders, while traders going long positioned their stop losses just below the support. What happened next? The market briefly broke below the support level, triggering the stop losses of long traders and activating the sell orders of breakout traders expecting a continuation downward. This move swept the sell-side liquidity that was resting below the support level. However, instead of continuing lower, the market quickly reversed to the upside. This sharp reversal is what we call a bullish displacement. To identify it, look for at least 3 consecutive bullish candlesticks with strong bodies, which signal strong buying momentum. While minimal wicks are recommended, they're not essential for displacement. What matters most is the aggressive price move with minimal retracement. In addition, you may notice a fair value gap forming between the bullish candles. This gap represents a price imbalance created by smart money entering the market. The fair value gap serves as a confirmation that institutional players were involved in the displacement. This bullish displacement shows how smart money used the sell-side liquidity sweep to drive the market higher, trapping retail traders who were positioned short and benefiting from the liquidity grab. Now, let's look at a bearish displacement example, which happens after a buy-side liquidity sweep. In this case, the market was trending upward and reached a key resistance level. Many traders expected the market to break through the resistance and continue higher, while others entered short positions, placing their stop losses above the resistance level. The market briefly broke above the resistance, triggering the stop losses of short traders and activating the buy orders of those who anticipated a breakout. This move swept the buy-side liquidity, resting above the resistance level. However, instead of continuing upward, the market quickly reversed, closing back below the resistance level and moving downward aggressively. This reversal marks a bearish displacement. To spot this bearish displacement, look for at least 3 consecutive bearish candlesticks with strong bodies, showing clear momentum to the downside. Again, minimal wicks are recommended but not a requirement. The key is the strong, unbroken move down with little retracement. As with the bullish example, a fair value gap may form between the bearish candles, further confirming the displacement and highlighting the presence of smart money. This bearish displacement illustrates how the market makers swept buy-side liquidity above the resistance, trapping retail traders who were long, before driving the price lower in the opposite direction. Why is displacement important? Displacement is crucial because it reveals when smart money is actively entering the market with large orders. These strong price moves signal the direction of institutional flow. Understanding displacement is key, as we'll combine it with other ICT concepts such as order blocks, breaker blocks, and fair value gaps to identify high probability trade setups. And don't worry, we'll cover all of these concepts in detail and show you exactly how to use them together to pinpoint those high probability setups. By the end of this video, you'll have a clear understanding of how to leverage these powerful tools like a professional. Up next, fair value gap, another crucial ICT concept. An ICT fair value gap, also referred to as an imbalance or inefficiency, is a crucial concept in smart money trading. It can be applied across various markets including forex, stocks, crypto, and commodities. The ICT fair value gap is identified in a 3-candle formation. The middle candle is generally larger, with a wider body, representing significant price momentum. The first and third candles are shorter and don't overlap the body of the middle candle. This creates a clear gap